Imagine waking up to headlines shouting, markets tumbling, gold skyrockets. Your investments feel like they're caught in a storm, and everyone around you's panicking. Yet the signs were all there all along. Major indexes like the NASDAQ had plunged nearly 14% from the recent highs. Actually, today, 18%. Gold just blasted past $3,100 an ounce, setting new records. And copper prices surged, signaling deeper economic concerns. But what does that all mean for you? Are we heading towards a recession, or is this just another bump in the economic road? I'm Kevin Ross, with over 3 decades in the financial service business, 15 years trading bonds on Wall Street. So together, let's decode these critical signals and learn how to plan your financial future right. Because life truly does happen fast.
Yeah, Kevin, that opening really hit home. You're seeing gold $3,100 an ounce. It's been bouncing around that line for a while. It was up and down today, but we're still over $3,100 an ounce. And you're seeing these spikes in gold and drops in the stock market. They're not just random events. They're indicators. What do you think specifically triggered this dramatic shift that we're seeing today?
Yeah, well, a couple things, and we're experiencing it with, the tariffs and everything. So, I think you hit a couple key points here, Matt. They're not random events. I think what's triggered this massive shift was kind of a perfect storm of investor anxiety, market uncertainty, and it's been driven largely by the tariffs and the political instability globally, actually. So when tariffs come into play, that means costs rise, the supply chains get disruptive, and global trade slows down. Investors hate uncertainty, and right now uncertainty is everywhere. Just recently we saw the NASDAQ drop 2.7%. That was as of last Friday. It's down another 3.5% today. This is April 3rd. That's in one day. S&P 500 is down about 9% from its high. Add in today, it's another 4. So we're talking about 13% down from its high. These are clear signs that investors are worried. So you combine this with some of the major banks like Goldman Sachs predicting gold could soar as high as $4,500 per ounce. These are extreme scenarios, and you have, as investors, racing towards safe havens. I mean, look at what they're doing with the car market. So, everybody's rushing out because they're worried that car prices are going to spike. And so unprecedented sell of cars. It's just panic.
I mean, gold is clearly seen as safe. I mean, I have it in my portfolio. I have since I opened a portfolio. But why exactly does gold matter so much? I mean, how does this shift affect average people listening right now who may not even be invested in the market just yet?
It's a good question, Matt. Gold matters because it's essentially the financial world's canary in the coal mine. Historically, when gold prices spike, it's an early warning that investors are preparing for turbulent times ahead. That means economic instability, rising inflation, or even a looming recession. And this isn't just a Wall Street story, it's a Main Street reality check. So when gold jumps, typically stocks fall, consumer confidence drops, and people begin to tighten their belts. So if you just look at consumer confidence, which was out the last Friday of the last week of the month, every month, it was at the lowest level in 4 years and well below the threshold that typically signals a recession. So for our listeners, this means reevaluating your financial strategies, perhaps shifting towards safer assets, and obviously staying alert and being prepared.
Right. Oh, well, speaking of consumer confidence, I mean, why does why does that matter so much? And is that more of a leading economic indicator or a trailing indicator? I mean, once consumer confidence, once we know it's shot, are we too far behind the eight ball?
Too far down. It's a great question. Consumer confidence is absolutely critical, Matt, because it measures how optimistic or pessimistic people feel about the economic direction. It affects how much they spend and how much they save. So when confidence is high, consumers tend to spend more, which boosts economic growth. But when confidence drops sharply, then people tighten their belts, they save more, they reduce their spending, which signals a potential economic contraction, right? So economists closely monitor this index because it indeed considered a leading indicator. It often predicts future economic activity before changes become apparent, like in hard data, like the GDP, gross domestic product, or employment, which comes up the first Friday of the month. It'll be out tomorrow. This recent dramatic decline signals caution ahead, for sure.
So we've also seen some volatility with new market entrants. With Newsmax, they surged dramatically, while the AI-focused CoreWeave, they struggled. I mean, what does that indicate about investor preferences and market dynamics right now?
Well, that's an excellent point. I mean, I would have thought everybody's on the AI bandwagon, but I think what it highlights is really the current mood of investors searching aggressively for maybe some short-term wins and some speculative opportunities like Newsmax. I mean, it soared 735% on its opening day.
Yeah, that's like a startup, like an IPO of some company you never heard of, but Wall Street has heard of it.
Yeah, exactly. And you had a lot of retail investors playing in it as well.
Yeah, the Wall Street bets crowd, and, investors of Reddit and things like that.
Right. Yeah, exactly right. So, meanwhile, the AI, which was last year's golden child, is facing some skepticism right now. We saw CoreWeave's flat debut, and this reflects a shifting in investors' confidence away from tech speculation and toward quick win opportunities that feel safer or more tangible in these uncertain economic climates. It's critical that our listeners understand these dynamics and avoid getting swept up in speculative trends. It's really, especially now with everything going on. And I would say that prior to the tech bubble or the tech going, selling off as much as it's sold off here in the last 2 or 3 months, this would not have happened. So CoreWeave would have gone public maybe in November, for example. It would have been the golden child for a while. And then as the tech market started to flounder, so would it.
Well, you mentioned tangibility there. And I mean, gold is one of the few tangible investments you can make. You can go buy gold and hold it in your hand. You can't go buy JP Morgan and hold JP Morgan in your hand. Or you can't go buy NVIDIA and put it in NVIDIA in your hand, but you can go out and get a gold bar.
Right.
So it's a tangible asset. It's a portable asset that's good in every country, I guess, right?
Right. And they're not necessarily buying the actual gold bars. You can, but they're buying gold ETFs.
It makes sense. It's a tangible idea. Right. I wear this stuff. It's in my electronics.
Exactly.
Yeah. Well, let's shift gears for a moment and let's talk about commercial real estate. We're hearing about rising delinquencies, which could signal deeper economic cracks. How serious is this for our listeners?
Well, it's one of the things that I typically watch because when you've got commercial real estate faltering and taking the delinquencies that it's reached, and just how significant it is, the delinquencies have reached levels we haven't seen in about a decade. That's incredible, really.
Yeah, I mean, those are businesses that are failing to pay their bills. So.
Exactly. So when they don't pay their bills, then they can't pay the corporations can't pay or the commercial real estate can't pay the banks what they're owed.
Right.
So we've got an increase in late payments on the loans. We've seen that. And this often means businesses are struggling. And in turn, banks become more cautious, which then reduces credit availability,
Right.
which then can ripple throughout the economy, which means less financing for expansion, for companies' expansion, less hiring, and more uncertainty overall. And this will trickle down also into the real estate side for the retail investor. So for investors, it's another indicator that we need to watch carefully. If CRE delinquencies keep climbing, it could pressure local economics and affect everyday people through job securities, right? Rent prices, and even broader housing markets.
Well, I'm glad you went to housing. Let's pivot to that. So home prices have surged roughly 38% over the past 5 years. And affordability is increasingly out of reach due to the high mortgage rates. With all of this happening, what is your take on the housing market for 2025? Will we see a recovery, or should buyers brace for continued challenges? I mean, are we knocking on the doorstep of another 07, 08 scenario here?
Yep. Well, Matt, it's a crucial question. And the housing market right now is indeed challenging. Home prices remain historically high. Mortgage payments have been jumping significantly they're up over 96% between 20 and 25, between 20 and 25, that 5-year period. Affordability continues to be a major barrier, especially for first-time buyers. So despite a slowing pace of price growth, low inventory in some areas keeps the price elevated. I did see actually today in the news that Tampa, where we're at, is the second highest percentage of decrease in their listings. So 30% of all listings they've decreased here in the Tampa Bay St. Pete area. The number one area was over in the Phoenix area. So not all of the areas are that way. New York and Connecticut surprisingly are off by like 5%, but some of the major areas that had the growth we're seeing, some major our high percentage of decreasing prices out there.
Well, I mean, I've seen in my own neighborhood, there's probably 6 or 8 houses for sale, and they've just been steadily decreasing the price.
Yeah,
10,000 off, 20,000 off, 25,000 off. They just keep lowering it, trying to get some takers, and they're not even doing a lot of showings either.
Right.
So they're doing just this weekend, they're doing a massive like a group open house.
Yeah.
All the realtors selling all the houses to pitch the same open house weekend. And they're going to be driving buyers in golf carts around, showing them all the other houses for sale, so we can get somebody to come in and put some money down on something.
Exactly, and so to me, that's a leading indicator that okay, we are going to face a slowdown here.
Right.
If you look at and listen to some of the real estate pundits that have their hands in that game, they're going to, like real estate agents, they're going to tell you, oh, we're okay. They always say, they said that in 08.
Yeah, it was just a gully.
It's just a little gully. And then we have the major financial crisis of all times.
Yeah.
So we're seeing some creativity, in your neighborhood, and we're seeing open houses with no one showing up. A lot of that's been mortgage rate driven.
Right.
However, the 10-year today is hovering right around 4%, just a hair over 4%. So we're about 70 basis points from the high. So we've had a rally in the 10-year treasury, which affects the mortgage rate. So we'll get a dip in the mortgages. But remember I talked about commercial real estate and the delinquency rate up there?
Right.
When that happens, banks don't want to give money, and they get really stingy with it, just like they did in 2010. You had to basically offer your firstborn to get a loan because they didn't take nothing. Now, 06, you had to breathe
Yeah.
And as long as you had a breath of air,
even.
you got a loan. And some, they weren't even real people,
Yeah.
kind of like some of the voters, I think. But yeah, that's a real thing. So rates lower. Do the banks give the loans out, or are they gun shy because of what's happening in the commercial real
It's going
estate
to
area?
be prime,
That's
prime
right.
customers, the only ones going to be able to get a
Exactly.
loan. And if
you're on
unless
the
they're looking to
cusp,
trade up or move to a new area, they're not going to be leaving their house anytime soon. They probably already got the house they want.
that's right. And the other thing that happens in this scenario is, like, I've seen a lot of new home builders that finally caught up with demand, and now they're not selling it because the rates are so high. So they're giving mortgage incentives, they're giving $20,000 towards closing or closing or upgrades, which that's a sign that they're hurting. Well, the problem is, if you wanted to buy a new house, or I wanted to go buy a new house, who's going to buy our house?
Exactly.
Right. And so people don't think through all of that. I really want this house. Well, who's going to buy mine? And when we are in this consumer confidence scare and everybody's frightened on this tariff, you start to see everything just kind of shut.
Everybody kind of goes into the shell.
That's right. They're going into their shell right now. And I think, we had a podcast a few weeks ago. We're talking about, are we stagflation or deflation? I said, you never really know when you're in stagflation until you're in deflation in a recession. And I think we're probably right now in stagflation, headed towards headed towards a recession. And I say that because this week, Friday, we have the job report, and based on the indicators that I'm seeing, I'm believing that the rates that we'll see a higher unemployment rate, which that was the thing I said a few weeks ago. Well, everything kind of points towards stagflation except for the unemployment that's got to rise.
Right.
And we could start seeing that, which now squarely puts us in there. And then when do we get hit over the head with the deflation?
And the housing landscape nowadays is vastly different from 06, 07, 08, 2010. I mean, those teaser mortgages, those ninja loans, those have been,
that's right,
they've been filtered out of the system. So would you say we're likely headed towards a crash, not likely headed towards another housing crash? Or, I mean, we tiptoeing on that line?
I don't think that we'll go down to below 2020 levels. Okay. I think that we're obviously, we're already coming down the high. I mean, I saw in some pockets like south of Tampa, prices have dropped 30% or more from the highs in 2022, 2023.
Right.
I don't think that's going to be across the United States, but I think you're going to see pockets. Austin's another area that had a high growth.
Regional bubbles.
You're going to have regional bubbles. I don't think we're going to go into an 08, 09 major housing crisis. I don't see that indicator yet. But again, it's, how long does this recession last, or whenever we do officially hit it? And then how long till the Fed comes in and they can lower rates, but then are the banks going to loosen? They can loosen up and give the money away, right?
Because that's what prolonged the Great Recession was the credit markets froze.
That's
the
right.
Banks weren't even lending to each other.
That's right.
And also, if you look back at the Great Depression, I mean, the stock market crash kicked it off, but it was, again, all the banks, all the lenders went into their shell.
That's right.
Like, we'll put money out when it's safe.
Yeah.
And they're all waiting for the other one to make the first move. None of them make the first move because it's a risk-based business.
Exactly. And I can tell you, from working with bankers for 30 plus years, they are the most risk averse people out there. They do not take a risk. It's amazing. Until, I think early on in the late 80s, I was, working for a major investment bank, and Trump sat in front of, I guess, 15 different bankers, and he owed everybody money. And he basically said, hey, this is all the money I've got. This is all the money I owe you guys. Obviously, it's whatever it was. I don't remember what cents on the dollar, but you guys need to figure out what you want to do. You can either extend me some loans, or you can own this real estate at, whatever it was, 25% of
exactly
what you gave me. And sure enough, they came and renegotiated it, and Trump went on to build his empire. But he got in the late '80s. We had some issues, and where did it start? Commercial real estate was the first thing that blew up, and then you saw the housing start to slump in the late '80s. And my first house I bought was in '92, I think, and I remember talking to an account of mine at an investment firm, and she was older than me, had a house or two, and she told me, if you can get a mortgage rate under double digits, you got to get it, because in the '80s everything, I mean,
double digit mortgage
you had mortgage rates that at the rate that credit card rates are at,
right?
So that was the life back then. Oh man, I got my first mortgage at 9.5%. And we basically
thought it was a steal.
Thought it was a steal. And now, it's like, oh my God, we got 7% mortgages. I'm like, God, I think I had 2 or 3 different mortgages at 7% over my, 30 years, until this last go around. So I think that we're in for some downturn here.
The homeowners today, though, they're different, right? I mean, before, homeowners back in the most recent housing crisis, they were paycheck to paycheck.
Yeah.
They were using the equity in their house as an ATM.
Yeah.
Basically paying for cruises and jet skis and depreciating assets. Which, I mean, would you say the homeowners today, they're a little more savvy?
Well, I mean, on the outside looking in, you think so, but then, here's the thing that you've got to watch. Commercial real estate continues to default. And money tightens. And so all of a sudden, people can't get to their home equity lines. They get shut down.
Or they waited too long and now their credit's taken the hit and now they can't qualify.
They can't get it. Right. And so what happens then is that continues to shrink, and they can't make payments, and they start defaulting on credit cards. They default on their car payments. That's all something. Car payment delinquencies are through the roof now. And a lot of that's just because we were in really, 3.5 years of hyperinflation.
Right.
Okay. And we had signs when the curve inverted back in 22. Has historically always been a recessionary sign when the yield curve converts. And because of the low interest rates, we just pushed through it. And we still had all this inflation, and now we're paying the piper here. It's catching up. And so now the consumer confidence is really starting to decrease. And I think everybody thought, well, when Trump comes in, he's going to magically lower the rates, which he can't do. He'd like to do that, spark the economy, which just creates more inflation. This is almost a healthy thing that we have to go through. And it's going to be, I think, pretty ugly here in the short term.
So, I mean, basically what you're saying is we need more houses and cheaper loans at the same time. And both those need to happen pretty close to each other for us.
Yeah, exactly. Because you've got a lot of young people in 20s and 30s that can't afford a house right now. So those prices got to drop, right? To make that more plausible.
Or wages need to come way
or
up.
Wages got to come up. Well, that's inflationary, right? So when you go into deflation, that means in this scenario that your housing prices are going to drop. They're going to become more affordable. The Fed's going to ease money. They're going to make the interest rates lower. And then the banks have got to be willing to give that money out. And a lot of it's going to depend on what's happening with the commercial real estate, because when those are big loans, when they default. So.
Yeah, a 50-foot or a 50-story building downtown goes belly up.
Yeah. Yeah.
That's a lot of bills.
And you think about it, it would have made sense for that happening in 21, 20, when everybody was working from home.
Right.
And now a lot of companies are like, you got to come back to the office. But if that's the case, then why are we having delinquencies? Well, because remember we talked about the first thing that goes is tech layoffs.
Yep.
And then you start seeing
the domino effect.
Exactly. Yep. And now we're seeing some of that domino. A lot of it's tech driven, but there's other companies that maybe supplied things to the tech companies that are feeling it as well.
Yeah.
So layoffs, they shrink office space. They don't need as much. And
So buyers short term, they should brace for
buyers,
housing buyers.
Housing buyers. I think if you got the ability to wait, especially if you're first time, it's coming your way.
Okay.
Okay.
And sellers should expect to wait.
Well, yeah. So you're not going to sell your house as quick, and you better be ready and put it in your mindset that, hey, I got to lower my sell price expectation.
Well, that's the desperation coming into effect. I've already put my down payment on the next house. I've got to get out of this one. It's not selling.
Right.
I'm going to take 40 grand off of it. We got to get somebody to buy this place.
Yeah, you almost got to,
even if you break even.
You almost got to say whatever your number is, and a real estate agent's going to argue with me because why? They get paid on the price to sell the house, right? So they want this to be inflated, but in reality is if you're trying to sell your house, you might want to get in your head it's going to be about 20 or 30% less than what I thought I was going to get.
Right. So Kevin, you've given us a lot to think about. Gold prices signaling investor fears, consumer confidence indicating economic caution. Speculative investments, those are reflecting a shift in investor priorities. Commercial real estate delinquencies, those are hinting at potential cracks in the kingdom here. And of course, the persistent housing market challenges that demand our attention and our strategic planning. So as we wrap up, remember, these headlines aren't just numbers, they're narratives that affect investments, our homes, our day-to-day lives, the price of eggs, as we've seen. We've covered gold as a safe haven, the importance of consumer confidence, the evolving speculative market trends, the shakiness in commercial real estate, and finally, the complex state of housing. It's all part of one big financial puzzle, and understanding each piece helps us stay prepared.
That's exactly right, Matt. Now's the time to protect and position yourself for whatever comes next. So review your portfolio, think about the housing market, factor in commercial real estate trends, stay vigilant about the economic signals. Don't let these challenges catch you off guard. Be prepared. You got to take charge of your financial destiny now so you can thrive no matter what markets throw at you. And just to expand on that a little bit, if you were 20s or 30s, somebody asked me, well, should I be buying the dips? Here's my response. It depends on your risk levels. Because I can tell you this, from doing this for over 30 years, when the market's up, no one's afraid of losing money. Because all it is the market goes up.
Yep. Until
it doesn't. And then when we experience what we go, this is the reality check. And so if you're 30 years old and this is killing you because you're seeing red and you see your financial statement come in the mail, that's hardly a thing anymore. Maybe for the seniors, it still comes in the mail. But you see it and you don't even look at it.
Because you just know it's bad news.
It's bad news. I don't want to see how much I lost, or I can't handle this, and you get depressed on it, then you're not, you don't have the risk tolerance that you thought you did.
Right.
And that's normal. So you got to say, okay, what is my real risk tolerance? You've got longevity. When you're 30, you got longevity, hang on. Okay. You need to diversify. Don't just buy Tesla because Tesla's taking a dip. Right. We talked about that earlier. Don't buy one thing because it's so cheap right now. You got to be diversified. Okay. For those of you that are in or near retirement, maybe you're in your 50s or even 60s, you don't have longevity. Unfortunately, we don't have longevity in our lives anymore. We're not 30. We don't have 50, 60 years left.
Well,
to weather
and the more stressful your life is, the shorter it's going to be.
exactly.
So yeah,
So if you're
in your 50s or
internalizing all
60s,
this
yeah.
stress, that's not good for you. So, and it's okay. It's okay if you miss the top or the bottom. It's really where you're at. If you are a school teacher, and I hate putting people in boxes, but I'm just going to do a generality here, and I know it doesn't mean everyone is. But if you are a school teacher, you're typically risk averse. You don't like losing money. You're a saver. And a lot of times the savers have more money than the people that are putting it all in because they've just had time on their hand. But those entrepreneurs out there that are all in, they typically have the ability to withstand the risk. They understand the risk a little bit more. They've gone into business for themselves. They're already betting on themselves. Those guys tend to weather these storms out a little better. Okay. But I can tell you, if you're not sleeping at night because of what's going on, and it's not going to get any better. It's not going to be like, oh, Trump turned the magic button and everything's good. I think in the long term, what Trump's doing with these tariffs, it actually plays out, and you're not going to get the truth from most of the economists out there because they tend to be on the left side. And so if this was Obama saying it, I think I told you this, if this was Obama doing it, then I think you'd hear some different things from a bulk of the economists. Tariffs can be a bad thing, but if you're listening to what's being said out there, and not just from a few of these media outlets, that all that's going on now is if you're charging me a 20% tariff, China, we're charging you a 20% tariff.
Right.
We're just trying to get the ball field equal. So here's the good news on the tariffs. You're living in the United States. You are a major consumer of most products that are imported in from other countries. So when you lose, from a business perspective, when you're losing your best buyers, your number one or two client, you feel the effect as a manufacturer. And therefore, you either scale back production or you lower your prices.
That's what we're looking for.
And so in the long run, this will be a good thing. In the short term, this is going to be bumpy. And if you can't handle the ride right now, you need to look at it. And if you're in your 50s or you're getting ready to retire in a few months or next year, you need to get with the financial advisor to walk you through this. And not all financial advisors are the same. There's financial advisors that are real good with the 30-somethings because it's accumulation and you got longevity, and eventually you're going to look brilliant. Like everybody looked brilliant for the last 10 years, even though some things didn't add up, economically speaking. But those advisors that are specializing in retirement planning, and if you're in that, then that's who you need to work with. You can talk with our group because we do both. But you got to get in with the right type of person, because accumulation planners and decumulation planners are two different people, and there's two different mindsets, and you've got to schedule that and be really proficient in it.
Right. And the longevity that you mentioned. So if somebody's in their 20s or 30s, it's kind of like they're walking into the casino with $10,000 and they are going to lose for the next hour. They're not going to win a hand. They're going to lose for the next hour. And then it's going to take them 2 more hours just to get back to even before they start turning a profit.
That's right.
So if they don't have that type of risk appetite where I know I'm going to put money at this, I know I'm going to lose, but the tide's going to turn and then I'm going to eventually be even and then eventually be back on top. That's an okay strategy for somebody that has some risk in their mind as far as their 20s and 30s, maybe even early 40s.
That's right.
50s and 60s, you're going to lose that. You're going to lose for that same hour, but you may only have an hour left.
That's right.
At the casino.
That's right.
So you've got to make sure that if you're losing small. And if you can get with, like Kevin said, get with an advisor that knows how, when everybody else is losing, if you're just staying flat, that's a win.
That's right.
I mean, you're winning compared to everybody else.
That's right.
And there are products out there. There's products out there even for these business owners that can't keep up with their bills in commercial real estate. There are products out there that they could have invested in with no downside.
That
gives them tax-free access to cash for exact situations just like this.
And that's what the uber wealthy do. And they not necessarily were uber wealthy when they started it, but because of that, they've got the ability to withstand these storms. And when business tightens, they're able to borrow from themselves. They're their own bank. So the banks can cut the money off. Things are really cheap. I need money. Well, they've got money because they have access to it. And again, if those are things that you're looking for, please like and subscribe to Plan Life Right. If you found this episode helpful, and I hope you have, share it with someone who needs a financial wake-up call. Leave us a review, because remember, life does happen fast. So plan it right, and we'll catch you at the next episode.